trend following is a basic proven strategy. All right. That's basically what we do. We follow the trend. If something goes up, we buy it and we hope it's going to keep going. Something goes down, we sell it and we hope it's going to keep going down. And if and when we get lucky enough to make some money, when it turns around finally, that's the time to get out. If we get into a trade and it goes against us and doesn't work out the way we thought it would, we have money management stops that tell us when to get out. So it's all very automated. We don't try to predict what the markets are going to do. I have no idea. People ask me all the time, what do you think about this market? What do you think about the economy? What do you think about the next week or the next 6 months or whatever? And I really have no idea. And people have a hard time understanding that because they think there's some kind of magic to what we do and how we can predict the future. And that's really not what trend following is. Trend following is just watching the markets, jumping on board when something starts moving, hope it keeps going the right way, and if it doesn't, get out when you're wrong with a certain predetermined loss, and then take the next trade and start over again. It works in every tradable market. We started trading commodity futures. Back then they were called commodities, now they're called futures. Sometimes they're called commodity futures. It's basically all the same thing. I'll put up my screen in a few minutes that you can see all the markets that I trade, and it's also applicable to stocks. The problem with stocks is that there's just a million different stocks to follow and it's too hard. It's also applicable to foreign currency futures. It's even applicable to options now. So no matter what you like to trade, even though I'm started off as a commodity futures trader, you can still do that. So let me take a minute and try and change the screen. I'm still working on this stuff. Hang on. Okay, so now I assume everybody can see a quote screen with all the different markets on it. Okay, and for those of you not familiar with commodities, they're organized in groups, just the way I first started when I learned how to trade. Everybody has their own organization, but starting up here in the upper left, we have wheat, corn, soybeans, rice, all the grains. The next group is all the currencies: British pound, Canadian dollar, Swiss franc, euro, the yen, the dollar index. The next group are the interest rates: the euro dollar, the 10-year notes, the 5-year notes, the 30-year bonds. The next group is the Dow Jones, the S&P, the NASDAQ, the mini S&P, the mini Dow, the Nikkei, all the different stock indexes. Coming over on the third column, these are all the metals: copper, silver, gold, platinum, palladium. These are all the energies: natural gas, heating oil, unleaded gas, crude oil. These are all the softs: cotton, sugar, coffee, cocoa, orange juice. These are all the meats: hogs, feeder cattle, live cattle, lumber, and a couple of other various markets thrown in the middle. And these are just things I look at every day. I look at this screen all day long. We really see nothing moving right now because all the markets are closed, except for a couple of stock indexes and a couple of energies, which might change 1 or 2 ticks every now and then. But pretty much these things are closed. But if you were to look at this a couple of hours ago, you would see all these things changing. You still see the bonds changing a little, the stock index is changing a little. They'll go for another 15 minutes or so, and then they'll stop for the day. And what I do is I'll look at the markets every day. I'll look for what we basically call channel breakouts. A channel is basically just a horizontal area on a chart. And just to give you an example, let's see if I can put up a chart. Okay, this is a chart of soybeans that from every bar is a day. From last October through March, for about 6 months, it was just going in one big sideways pattern like this. And then a couple of weeks ago, it started going up. And at a certain point, which there is an exact mathematical number or a certain point on the chart of how many days it's gone up or how many points in price it's gone up, that's the time that we say, okay, it looks like it's going up. Maybe we better buy it, jump on board. And we have no idea what's going to happen. If you look at what happened in the past week, soybeans basically exploded over $1 in price, which is $50,000 a contract. I have no idea why. I've heard stories that weather forecasters are predicting a hot, dry summer in the Midwest this year. I've heard stories that hedge fund managers are tired of putting their money in stocks because the stock market is too high, so they're looking to invest in fungible commodities like food products. I really don't know, and I really don't care. My job is not to predict the markets or to understand why they're going up. My job is basically just to follow the trend, and when it starts moving, I get on board. I have a predetermined set amount of money I'm willing to lose on every trade. If I hit that stop loss, if the market were to go against me, I would hit that stop loss, I'd be out, and I'd wait for a new trade to come along. If the market starts going my way like this has happened, and there are a couple of them like this, I have no idea how high it's going to go or how far it's going to go. And I don't know when to get out. I don't know how to take profits. That's not really part of our strategy. The answer of getting out is after it's turned around and started going down. And that's the only way I know. For example, if I put up a chart of the bonds here, you can see for the past couple of months, the bonds were going straight up, all because of the Fed's policy of easy interest rates. The past couple of months, they went sideways a little bit, and it started up again. And then just today, as a matter of fact, they finally cracked enough that I could look at this and say, oh, well, the trend is not up anymore. It's time to get out. So this is something I probably bought very well back at the beginning of the year and literally finally just got out today on this big down bar right here. And that's how I know when to get out. After the market's turned around and gone a certain amount of points or price against me. I never get in at the bottom. I never get out at the top. I wait for the market to show me some movement before I decide to commit a position, and I wait for the market to show me some movement against me before I get out. Every one of these charts that we're going to be looking at, every bar is 1 day. You can see the scale on the bottom. So this whole chart will go back to last summer. Every one of these bars is a day. I can spread it out if you want to see it more clearly. Again, I just like to look at candlesticks. The green days are up days, the red days are down days. Makes it easier for me to see what's going on. But this is about the size that I like to look at it. Just to show you something that's really a little bit more dramatic that everybody trades. This is the E-mini S&P. Again, every bar is a day. Let's see if I can do this. Okay, that'll show you more time on the chart. For those of you who remember, last summer, the stock market basically collapsed in August, went sideways for a while, rallied back towards the end of the year. By November was making new highs, went sideways into the holiday season, and right at the beginning of the year, crashed again. I don't know why. Markets go up and down, I guess is the best answer to tell you. And again, everybody in January was predicting a horrible start for 2016. They talk about a 10% sell-off, meaning the market's in a correction. I don't listen to any of that stuff. These guys on TV, they don't know what they're talking about. But I'll tell you this, the more that they talk about stuff on television, the more you know it's about to be over. That is a psychological phenomenon that is unbelievably accurate and always has been. And back in January, everybody was talking about how the stock market was going to collapse. And look at the rally we've had the last 2 months, and we're back up to lifetime highs. This is the E-mini Dow Jones, which is at lifetime highs. This is the S&P, which is very, very similar. Like I said, I don't know why. I know there's a bias in the long-term stock market to the upside. I can't understand why, because we have no inflation. And the stock index is made up of 100 different companies, some of which are doing well, some are not. So again, it's not my job to understand why the stock market's going up. It's not my job to understand why soybeans are going up. It's not my job to understand why silver is going up. Silver is now at $17 an ounce. I mean, if you look at last November and December, it made what people would call a classic rounded bottom. We really don't use that kind of language. But at some point, right around here in February, it sort of broke out to the upside, failed a little bit, broke out again, failed a little bit. These were losing trades, by the way. Took a 1 or 2% loss on our capital. We have a rule that says basically never risk more than 2% on any trade. So if you get into a position and it goes against you to the point where it's cost you a 2% loss in your account size, that's the time to dump it and get out. And then get back in again if it makes new highs. And what's going to happen is markets are not going to go in a straight line. We're usually going to get chopped up a little bit. We do wind up the year having more losing trades than winning trades, believe it or not. But the losing trades are limited to 2% of our account size, whereas the winning trades can be 10 or 20%. Like I said, soybeans, right now, a daily move in soybeans is probably $2,000 a contract. So if you had a big account size and you lost $4,000, you would be out of the trade. That probably happened once or twice. But in the past week, you probably made $50,000. You might make another $50,000 before this trade is over. Today might be the high, and as of tomorrow, it might turn around and start going back down like this, and at some point, it'll be time to get out. Once again, I don't know that. I don't predict that. I don't spend my time worrying about that. I know that every year there's going to be a bunch of choppy markets and a bunch of losing trades. And also every year, I know there are going to be a couple of big winning trades that are going to make up for things. And if you add it all together, you wind up with maybe 60% losers and 40% winners. But the winners are a lot bigger than the losers on average, and that's how you wind up making money. By the way, this works not just on the upside. I mean, I've shown you a lot of markets that have been going up, the stock market, the bond market, silver, soybeans. You know, you can look at all those things, but this works on the downside also. Here's a chart of the U.S. dollar, the dollar index against a basket of about half a dozen different commodities. We are short the dollar index. We've been short basically since right around here, this big day when it collapsed in the beginning of February, and we're still short now. So you can make money on the short side. Here's a chart of feeder cattle, which is a little bit choppy. You see these gaps. The gaps are basically every time there's a new month rollover. But basically, feeder cattle has been in a downtrend since last summer, and we're still short today, making new lows again. So this works both ways, on the upside and on the downside. Sometimes you have a lot of markets going up because they're all correlated. Sometimes a lot of markets going down. Sometimes, like right now, we have 20 long positions and 10 short positions in the different commodity markets. So some are going up, some are going down. Try not to worry about the correlation too much. I can't explain to you why beans are going up when cattle is going down. Again, that's something I really don't care about. I mean, I have a master's degree in economics. I can go through all the reasons fundamentally of why this stuff is happening, but the truth of the matter is I might be right, I might be wrong. All these guys who talk on TV about why the markets are doing what they're doing or how they're doing what they're doing, they don't know what they're talking about. They really don't. Their job is to make people comfortable. Their job is to give explanations, or what I call rationalizations, really, of why markets are doing things, even when they're not really doing anything. So you never know what these guys are talking about, whether it be Najarian or Kramer or anybody else on TV. You know, it's really scary to listen to these people and think they know what they're talking about. When Rich Dennis taught us how to trade, he taught us how to look at charts. He taught us how to look for breakouts. He taught us how to measure breakouts, and I'll tell you that in a few minutes. He taught us how to use money management to figure out how much of a position to take and where to put our stops. He never taught us anything about fundamentals or economics or psychologicals or anything like that. In fact, he told us totally ignore the fundamentals because they're often just plain wrong. Everything I do is pretty much 90% technical analysis and 10% common sense, and it's backed up by a lot of math and statistics and money management formulas that tell you where to get in, where to get out, how much to risk, and that's how we keep control over what we do. Basically, if I'm looking for a trade, what I want to look at, let's go back to soybeans because it's such a great example. Let's go even to corn, which is an even better example. This is corn that's been going sideways since last October pretty much. And then just a couple of days ago, if you can see this line right about there, right? When it broke out about above $3.75 a bushel about 4 or 5 days ago, all of a sudden, boom, we had a big sideways channel that looked like this, that was going on for months, and all of a sudden we exploded out of there. That's the type of trade we look for, whether it be on the upside or on the downside. Now, the simplest way for us to measure that is we will go back and look at a chart and just count the number of days or count the number of bars. Remember, every bar is 1 day. This is a daily bar chart. And we want to look at when is the market all of a sudden higher than it's been in the highest high of the last 20 days or 30 days or 50 days. And if you see right here at 375 on April 15th, all of a sudden the market went higher than it had been for the highest 20 days, 30 days, all the way back to 50 days. And the more days back it takes out a high or a low, the stronger the signal is going to be. So in simplest turtle terms, we want to look for a market. We want to buy something that's made the highest high of the past 20 days. If it's made the highest high of the past 50 days, that's even better. But our basic signal is buy something when it's made the highest high of the past 20 days, or sell something short when it's made the lowest low of the past 20 days. Same thing in reverse. Longs and shorts are exactly the same way. They're treated exactly the same way. So we want to buy at the highest high of the last 20 days. We want to sell at the lowest low of the past 20 days. If we're wrong, we want to calculate based on our account size and based on how much is the value of a tick and based on how much market moves every day on average, what we call average true range, average daily range. We can calculate how much to risk. If we have $100,000 and we want to risk $1,000 or $2,000, we can back into how many contracts we're actually going to take on that position. There is a bunch of formulas, and there is about 2 hours worth of math that I can go through, that I do go through in the course, which is obviously beyond the scope of this 1 hour discussion. But again, it's all very much laid out. It's not guesswork. It's not hunches. It's all mathematically precise. I have a course that I put together basically based on the notes that Richard Dennis gave us, based on my own notes, based on experience over the years. I have a course that I used to teach a weekend seminar. I put together a manual that's almost 400 pages long. I have 16 hours of DVDs that basically bores the hell out of me, because I've talked about it for so long. But I guess most people find it interesting, at least the first time around. Sometimes they find it confusing, but I'll just keep on going. The good thing about having the DVDs is you can play them over and over again until you get something that you don't understand. We have a whole list of criteria of when to get in and out of trades. Like I said, the basic signal is the highest high or the lowest low of the past 20 bars. The basic money management rule is a 2% loss. There is no profit rule. We don't know how high the market's going to go or how low the market's going to go on the short side. We obviously want to maximize our profits because we know we're going to have more losing trades than winning trades during the year. So the only way we're going to make money is to make sure the winners are as big as possible. So probably the worst mistake you can make is to get out too soon. So we never know where we're going to get out, and the only way we get out is after the market turns around and goes against us, which in corn or soybeans or silver has not happened yet. In stocks has not happened yet. In bonds, as I showed you, just happened today. We exited the bonds today. Give you another one. Just give me a minute. I'm still learning to use these cursors. Let's try this. Here's another market we exited today. As a matter of fact, this was orange juice, which had a nice little run up last October. Don't say why. I don't know. I mean, I live in Florida, and people used to say, oh, the markets always ran up because there's worry about a freeze. Well, nobody worries about a freeze in Florida anymore because technology has gotten to the point where they can put infrared heat lamps out in the crop fields. So I don't know why orange juice runs up. Sometimes it runs up in the winter. Sometimes it doesn't. You know, it ran up last October, November. We made a little money. Went right back down at the end of the year. Started running up again probably around the beginning of March. And we made a little bit of money. We got in right about there. If you can see, that's right about there at 130 is about the highest high of the past 20 days. So that's where we are right now. And we ran up a little bit. We had no idea how far it was going to go. It didn't go very far, unfortunately, until it turned around and went down. And again, today, right there, is when we got stopped out. It went lower than the lowest low of the past 10 days. So that's going to be our exit signal, basically. When the market turns around, if we're long and it goes lower than the lowest low of the past 10 days, we're going to get out. If we're short and the market turns around and starts rallying and goes higher than the highest high of the past 10 days, we're going to get out. So that's it. Basically, our basic entry rule, highest high or lowest low of the past 20 days. Basic exit rule, lowest low or highest high of the past 10 days against us. Basic money management rule, 2% of your account size is what you lose, and then you got to throw in the towel and move on to another trade. The biggest thing about what the Turtles first started doing, and the reason that Rich Dennis taught us all this, is portfolio diversification. We have no idea where the next big trade is going to come from. So I trade about, like I said, about 50 different commodity markets, all listed on the screen here. Obviously, depending on your account size, you can't trade all 50 of them. So one of the things that I've done over the years for people who don't have institutional size accounts is I've made up different portfolios for different people with different account sizes. So if you've got a couple of $100,000, you can trade all 50 markets. If you've only got $25,000 or $50,000, maybe you can only trade 5 or 10 markets. I pick the markets that I suggest to people to trade based on portfolio diversification. You know, I'll pick one grain, one metal, one soft, one currency, try and mix them up a little bit. They're also based on margin requirements. They're also based on volatility to make sure that nobody blows themselves up too much. And that's the way we adjust and start doing it for smaller accounts. And that's worked pretty well. In fact, that's worked better than I expected when I first started doing that about 10 years ago. I personally was afraid that if you didn't trade all the markets, you weren't going to catch all the power of diversification that the turtle system does. But it turns out there have been years where small accounts that only traded 5 or 6 markets did better than people who traded 40 or 50 markets. And the reason being, if there's only going to be a couple of good trends a year, and those trends happen to be in the markets that the small people are trading, well, they're going to catch those big moves more proportionately, and they're going to miss a lot of the choppy markets that people who trade 40 or 50 markets are going to wind up taking losses in. So it's very possible that you can trade a small account size and wind up doing better than people who trade a large account size. And that's just the way it goes right now. So don't ever worry about the fact that if you don't have enough money to trade all the markets that you're going to be missing out on something, because that's not really the way it works. That's pretty much it for what we do in commodities. There's a lot more, obviously, that I can't go into in a short time span. Like I said, I do have a course, I do have a book, I do have 16 hours of DVDs to teach all this stuff. And quite honestly, most people don't want to bother to learn it. And so what I've done, give me a minute and I'll find something else to put up for you. Let's try this. I know I got to change the cursor again. It's harder when you do it on remote, but let's try this again. Okay, so now we've got what's called an order sheet, right? Everybody can see the order sheet. It should say on the top, orders for April 20th. Okay, if you guys can see that, just somebody say yes. Yes, no, anybody? There we go. Thank you, Brandon. Okay, so about 10, 15 years ago, a cottage industry grew up in the brokerage industry where people who wanted to trade systems and didn't want to do the work themselves, the brokers said, okay, I'll do it for you. You give me a letter of direction or a power of attorney of whatever system vendor you want to follow, and I'll take the trades for you. So it got to the point where I send out an order sheet every night now. Let me take 5 minutes to go through this. And by the way, we do this at 5 o'clock every afternoon after the markets close. We sit down, we figure out all the signals for the next day. And I don't want to go back to the charts because it's wasting time. But if you know that you're looking for the highest high or the lowest low of the past 20 days to get a buy signal or a sell signal, well, you know in advance what that price is going to be. Like in the corn example, you could have been watching for a week and knew that if it ever broke out above 375, you were going to go long corn. So you don't have to watch every day. We know in advance. Somebody asked a question. I'll answer that in a minute. There's going to be time for questions at the end, not necessarily from me, but the moderators are going to put up a website and a phone number, and you guys can email your questions or call in your questions, and we've got brokers and marketing people that are going to be able to answer all the questions, and if they don't know the answers, they'll get to me and I'll answer the questions and they'll pass it on to you. So you'll know exactly what we're going to do. Okay? But anyway, this order sheet that I have on the screen now goes to both customers who sign up for the course, and also goes to brokers who auto-trade the course for different people if they don't want to do it themselves. This goes out every night between 5 and 5:30, and it has the orders for the next day. I'll go through it page by page, and if Steve is listening to this at home, just wait a few minutes before you print out the orders for me, because the printer makes noise and interrupts me, so just give it a few minutes. But basically, we have an order sheet. This shows all the positions that the total system has right now. All the long markets, all the short markets. We got about 15 or 18 long markets. We only got 5 short markets. These are the different symbols. If you don't know the symbols, you can get them from your broker or from the exchangers or whatever. The Aussie dollar, BOK is bean oil, CDM is the Canadian dollar, CN is corn, CTN is cotton, all the way down the list. So these are all the markets that we got into the day we first got into them. Some we've been in for a couple of months, some we just got in a couple of days ago. The market, the number of contracts based on $1 million account, which is how TradeStation rounds off the account size for everybody. And of course, if you have less than $1 million, we teach you how to adjust the number of contracts accordingly. The entry price that we first got in at, which was the breakout price on the chart, and the last price, which is today's closing price. And obviously, if today's price is higher than the entry price, for example, the Aussie dollar, we got long at 71.99. Now it's up to 7,800. We got 600 points profit in there. If the last price is greater than the entry price, we got a profit. If the last price is less than the entry price, we've got a loss. If it's going to be more than 2% less, it's not going to show up on the sheet because we're going to be knocked out of it. Conversely, on the short side, for example, we sold the dollar index at 95.97. Now it's at 93.94. We got about 200 points profit in the dollar index. We sold feeder cattle at 153.60. It's down to 145.77. We got about 800 points profit in feeder cattle. Unfortunately, Kansas wheat, we sold at 469. All the grains rallied. It's up to 487. We got about a 20-cent loss in feeder in Kansas wheat, and in fact, we got stopped out today. This is last night's sheet. So all the long positions, all the short positions, and then all the rest of the markets that were flat. On the second page, again, this is yesterday, all the orders that got filled from yesterday. All the stocks that are associated with the open positions on the first page. Okay, here are the 5 markets that were short, and here's our buy stops to cover in case we're wrong. The dollar index feeder cattle, obviously, still a long ways away. Kansas wheat, we got stopped out today at 490. We actually turned around and went long. It went up to 496 or 497 today. Then all the markets that were long, that we've been long for a while, all the associated sell stops, the entry name, some means it's a 10 or 11-day exit, some means it's a 2% loss stop. Again, if you go through the orders or you go through the course, it'll tell you what all these symbols mean. So these are basically the different stops. For all the markets we don't have a position in, here are all potential new buy signals. And there's going to be, well, for long about 20 markets, there's going to be about 30 new markets that we have potential buy signals in that we're not in yet. For example, crude oil. We had a buy at 43.68. Crude oil broke above $44 a barrel today. We went long crude oil. What else did we buy today? Oh, we bought Kansas wheat at $4.96. We got stopped out of our shorts. We turned around and went long. So this is the third page of the order sheet, all the potential buy signals. This is the fourth page of the order sheet, all the potential sell signals. We're only short 5 markets, so we've got a whole list of about 45 different markets that we could potentially be going short, none of which we sold today because all the markets seem to be in an uptrend. Like I said, they tend to all go correlated together. All the grains are running to the upside. I'm not sure why. I don't really care. All the metals and energies seem to be running to the upside. So there may not be a lot of short trades coming in the very near future, but we have this list. We'll have this list sent out to you every day or sent out to your broker if you choose to have him do it for you. Finally, on the 5th page, this is a little confusing if you haven't gone through the math that I said we don't have time to go through, but it's basically all the different contracts, what the tick value is, what the dollar volatility is, how much it's going to cost you on a daily move for one contract, so you can figure out going backwards based on your account size how many contracts you can trade, so that if you take a 2% loss against you, it's going to cost you 2% of your account size. Again, this is something that takes a while to explain. There's a whole chapter in the book. It actually takes me about 2 hours to go through this in the seminar on Saturday afternoon. If you want to go through it, that's great. If you don't want to go through it, you don't have to. The brokers can do it for you. Most of the marketing people know how to do it for you. So that's basically the order sheet that gets sent out every night. Okay? And that covers the commodities. And that's what I do. I teach a course. It costs $1 zillion. Actually, it doesn't cost that much. It costs a fair amount of money. I'll let the marketing guys tell you how much it costs. But whatever it costs, it's worth it. You'll hopefully make your money back within the first year, and then hopefully just be on the road to profits ever since then. Okay? Let me go back to the turtle, if I can find out how to do that. Let's see. Where'd he go? Oh, how about this? This is what I look like in real life. Hang on, I know. I had to change the arrow thing again. All right, this is me in real life. I'm not green. I've got a real face. People used to see this picture, thought I worked for BMW. I bought a car a couple of years ago. They gave me a shirt. Big deal. If you buy this course, maybe I'll get you a turtle shirt. I have a shirt that says "Fear the Turtle" on it. That came from the University of Maryland because that was their football team mascot, the Terrapins, and they have a shirt that says "Fear the Turtle." So I made up a bunch of shirts that say "Fear the Turtle." If you want a shirt, we can get you one. Okay. But this is what I look like in real life, at least on a winning day when I'm smiling. Okay, so we've covered the commodities. Let me talk real briefly for about 5 minutes about the other stuff that I do. About 10 years ago, when currency trading or Forex trading became very, very fashionable, everybody wanted to trade Forex, and the currency markets were some of the best trending commodity markets ever since Rich Dennis taught us back in the 1980s. So I took the basic turtle rules, tweaked them a little bit, got a Forex trader to help me, and a computer programmer to help me, and we developed a whole system called Turtle Forex, which is very similar to Turtle Commodities. It's got some different rules because the Forex are 24-hour markets. It's basically the same trend following principles, although the entry and exit rules are sort of different. The filters are sort of different. The money management rules are a little different. But we've got a whole course based on Forex. And again, the same thing. I've got a book. I did a seminar. I've got a bunch of hours of DVD on tape. I've got a course that I can send to you. I've got Forex brokers that will auto trade for you if you want to do it. And it's just diversification, basically. So that's my Forex course. Before even the Forex course came along, let me tell you about stocks. I never traded stocks because the problem is there's 1,000 different stocks to look at. There's maybe 50 different commodities, so I can look at, if it takes me a minute or 2 minutes to look at every commodity chart, like I showed you a couple of them, I can look at every chart. It takes me an hour or 2 hours every day. And that's all I do every day. And we have TradeStation programmed to help look at some shortcuts so that Steve and I can generate the orders in about 15, 20 minutes at the end of the day. The problem with stocks is if there's 500 stocks in the S&P as opposed to 50 commodities to follow, even if it takes a minute to look at every chart, you're spending 8 hours a day just looking at all the damn stocks. So stocks are not very feasible to trade. What happened was I had a programmer, very smart guy named Malcolm, about 15 years ago. He was into the stock market a lot, and he came up with a program to trade the stock indexes. Not necessarily the stocks themselves, but the stock indexes. The Dow Jones Index, the S&P Futures Index, the NASDAQ Index. And that's a whole different course. And that's totally different than the turtles because stocks and stock indexes don't trend as well, even though I showed you a stock market chart that looked great. Stocks tend to back and fill more often. They go up and down, they hit support and resistance. So we have a system called the Balanced Trader for stock indexes, which basically buys the stock market maybe once a month, holds on to it for about 10 days. It beats buy and hold. We're in a trade right now. We're going to get out tomorrow with about $5,000 in profits, trading one of each of the 3 mini contracts. Again, the Balanced Trader is a different course. It's got a book. It's got some DVDs. It's got a seminar. Well, no, it doesn't have a seminar. I didn't talk. But it has a pretty comprehensive book that Malcolm wrote. And again, it's automated. It runs on TradeStation. The brokers can do auto trading for you. So basically, I've got everything covered now. And this is something I learned the hard way. I was a commodities trader for 20 years, and I really didn't pay much attention to foreign currencies or stocks or options or anything else. Now I'm at the point where I've got 3 different programs. My bread and butter is still the commodities. I've also got a program for Forex. I've also got a program for stock indexes. And anybody you talk to on the marketing side or on the portfolio management side of things will tell you that the best way you can possibly trade is just diversify your assets among different things. So if you've got enough money to trade different assets, asset allocations, and if you've got enough money to buy the different courses, and there is a price break if you buy more than one, you'll do better buying the commodities and the Forex and the stock indexes and trading all of them simultaneously rather than just concentrating on one. If you can only afford to concentrate on one to get started, I would say start on the commodities, because the commodities also have currency futures and stock index futures, and so that covers a little bit of everything. And by the way, just recently, literally just in the past couple of months this year, we have developed, or in the process of developing, something for options, so that people who trade options can buy and sell calls and puts instead of buying the underlying futures contracts or forex contracts. So you can do options on this stuff also. So that's going to be a fourth product that we're going to have coming out soon. And I think that covers pretty much everything. I know I've talked for an hour. Hopefully I've covered everything that I can cover within an hour. Whoever's got their mic on, please turn it off because we have echo. So I'm going to wrap it up. I'm going to let Kevin Driscoll come back on, or let Kathy Meyer come back on, who's been helping me run this. Like I said, they're going to put up a website or a phone number that you can write in or call in, ask questions of the brokers and the marketing people, and they will take it from there. And part of the thing that I offer as a service, by the way, if you get involved in this, you can always, once you get the course, you can always call me or write to me directly. You'll have my email address. You'll have my office phone number. You'll have myself or Steve, my computer programmer, and we're always happy to answer questions for people, or if the marketers, if they can answer that, great. If they can't, they'll ask me and I'll get back to you. So there's a lot of support service that goes on with this as well. So that's pretty much it. I'm going to take down my smiling face. I'm going to add up how much money I made today and hopefully go out for a steak dinner and turn it back over to Kevin. Thank you very much for listening to me, and I hope to hear from some of you guys again. So unless there's anything else, I'm going to turn off the mic and say bye-bye for now. Hey! Thank you. Thank you. Bye.
I want to thank everyone. Thank you for coming. They're basically answered because Russell does have an investment strategy, and the strategy can be auto-traded. He teaches the strategy himself to anyone that enrolls in the class, and it can be traded with as little as $10,000, meaning you don't need to have $1 million account.